Thank you, Shobji. Hello, everyone. Good morning. I hope everybody has joined in. I'm just waiting for a minute so that everybody joins in, and then we will start. Okay. So I hope everybody has joined in. Again, a very good morning and a very happy Diwali to all of you. I hope you all must have celebrated the Diwali yesterday. Might be few are celebrating it today. Okay. So the topic for today is Ind AS 37, provisions, contingent liabilities, and contingent assets, right? So there are three items, the standard deals with. Number one is the provision. Number two is contingent liabilities. And number three is contingent assets, right? So these are the three items we will understand in detail. What provision means, what contingent liability means, what contingent asset means, what is the difference between all of these three terms, and what we are going to do with all of these three items in our financial statements, right? So that's the agenda for today. Now, what's the objective of this standard? So the standard provides a recognition criteria. Okay. So on what basis we will recognize something in our books of accounts, right? And the measurement basis, right? Which will be applied for these three items, right? So how and when these items will be recognized if there is a need, and how they will be measured, right? So these are the two objectives the standard has, brought to us. And it deals with only three items, as I previously mentioned: provisions, contingent assets, and contingent liabilities, correct? Now, there are certain disclosures as well, which the standard requires around these three items, right? So what is the information which will be disclosed? What is the purpose of that information is to enable the users. Who are the users? Users of the financial statements. It could be stakeholders, right? It could be investors. It could be bankers, right? Other lenders, right? And government, right? Or any other, individual or an institution who is interested to know the performance, of the company, right? Company's financial position, right? So all those are users of the financial statements. So it is the objective of these disclosure is to enable these users to understand the nature, the timing, and the amount of these three items, right? Right. So how these items are affecting the financial statements or the financial position of the company, how the nature, what is the nature of these items, timing when they are going to accrue or arise to the company, and the amount, by what amount they will accrue or arise to the company, right? So these are the three items which are, being disclosed by way of these disclosures which the standard has asked for, right? So that's the objective of the standard, correct? Now, what is the scope? So the scope of the standard is Ind AS 37 applies to all contingencies, right? So whenever there are any contingencies, right, in relation to any item, right? So Ind AS 37 comes into play and guides us how to deal with these contingencies, right? So, for example, company is having a lawsuit in the court of law, right? The case on the company by any of its suppliers or any of its debtors or any of the vendors, whoever, right? So, what would be the outcome of the case law, right? So there is a contingency, right? So because we are going to deal with this contingency, so India's 37 comes into play and advises how to deal with, right? What is the requirement to do in the financial statements on this contingency, right? Whether there is a provision required, if no provision is required, whether there is a contingent liability disclosure is required, and if the contingent liability disclosure is also not required, then how we are going to deal with this, right? So all these discussions we will continue to do throughout during the day and the next session, and I'll ensure that I will do enough practicals as well so that you understand the concept very well. Now, there are three exceptions. So, except certain contingencies, for example, financial instruments, including guarantees within the scope of India's 109, right? So, sometimes you must have heard that, holding company is giving a financial guarantee to the banker on behalf of its subsidiary company who has taken a loan from the bank, right? So subsidiary company is taking a loan from a bank or some other lender, and to that lender, holding company is giving a guarantee that if the company subsidiary company defaults, then I will honor, right? So these are called financial guarantees. Now, whether the subsidiary company will default or not, that we do not know on the date of giving this such guarantee, right? So there is a contingency, right? But this contingency is not within the scope of India's 37. Why? Because there is a altogether separate standard, India's 109, which specifically deals with this particular contingency, right? Because India's 109 has explicit accounting guidelines, explicit disclosure guidelines, explicit measurement guidelines. How this how this financial guarantee will be measured, when this will be recorded, how it will be, amortized, and what all disclosures will be made. All things are being discussed under India's 109. That's why India's 37 is specifically excluding this particular category of contingency. Is that clear? Any questions here? Yes, no?
Yes, clear.
Thank you. May I know who was the person?
Sanjay.
Thanks, Sanjay. Okay. Then there are certain other contingencies as well, which are covered by some other indices, right? What are those? For example, India's 115, revenue from contracts with customers, right? So there are certain, contingencies dealt within there as well. Whether the contract with the customer, is executory or onerous, right? So if it becomes onerous, then only, India's 37 comes into play, right? Onerous contracts, because onerous contracts are those contracts where, fulfilling the contract is, a loss making instead of not fulfilling that, right? So there is a additional liability or provision, requirement gets triggered on the date of the contract becoming onerous, right? So in case onerous contract is not there, all the contracts are executory contracts. So those are perfectly dealt by India's 115, right? With all of the customers, right? Whether there will be sales return or not, whether the customer will be satisfied with our services or not, what are those? So all those things are well captured within India's 115 by its 5-step model, right? 5-step model means identify the contract. 115 is covered in this batch or not by now?
Yes, covered. Yes, covered.
Yes, covered, right? So you must have, worked upon on identifying the performance obligations, right?
Yes.
So identification of the performance obligation is the step whereby all the contingencies are dealt with, right? So performance obligation, unless and until satisfied, we don't recognize any revenue, right? So only when performance obligation either satisfied or expires, then only, we will record the revenue. or reverse the contract liability, right? So 115 is designed in such a manner that whatever the contingencies involved in any of these contracts with the customers is well, taken care, right? Then India's 12 income taxes. We do not know whether the income tax department is going to serve a scrutiny notice on us or not, right? Whether the taxes which we have assessed are going to be accepted by the income tax department or not, whether there would be additional demand of taxes or not. So these are the contingencies, right? But all these contingencies are not to be dealt by India's 37 directly. There is a specific standard, India's 12 income taxes, right? So that takes care of this. Unless and until there are any case laws running in the court of law whereby, we need to record certain provisions basis on the probable outcome of the case law, right? So unless and until there is a case law, then only India's 37 gets triggered, otherwise not. Until then, India's 12 is taking care of that, right? Similarly, India's 116 leases, right? So in 116 leases as well, there are certain contingencies involved, right? So contingencies are everywhere. So whatever we are going to do in the business, right? Whatever nature of transactions we are entering into with any party, right? There are certain set of contingencies, right? Whether whatever is being agreed upon today will continue to prevail over the next few years or not, or over the contract life or not, whether the contract will be completed or whether the contract will be cancelled or terminated before that, right? So there are contingencies. Now, by whatever standard these transactions or contracts, are governed. So those respective standards are taking care of the accounting aspect of these items, right? So there are certain set of standards. For example, 115 takes care of the contracts with the customers. India's 12 takes care of the income tax liabilities. 116 takes care of the leases. So when we are, giving anything on lease, right, or taking anything on lease, so India's 116 gets triggered. Then similarly, India's 19 employee benefits, right? So whether our employee will continue with the company or will depart, right? So that there is a contingency, right? So we are accruing the employee benefits in the form of short-term, long-term benefits, right? Short-term benefits, long-term service awards, gratuity, pension, etc., ESOPs, right? So if the employee leaves, then what's the point in accruing the liability for that very employee, right? With our P&L or the balance sheet, right? So all these contingencies are taken care by the actuarial valuation within the India's 19. So India's 19 is taking care of all these contingencies, whether the employee will continue with the company or not, right? So there are contingencies involved, but these standards are taking care of that. So that's why, because there are specific standards around these contingencies, so India's 37 is simply saying, because there is a separate set of standard which is taking care of all these contingencies, so these specific contingencies are not within my scope. I will cover only on general contingencies which are not covered by any other standard, right? Similarly, for insurance contracts, right? So insurance companies do not know whether the claim will arise or not, right? If the company is into the life insurance business, they do not know whether the insured person will suffer any life threatening disease or not, right? Health insurance, we do not know when and how many customers are falling ill, how much claim we are going to receive in the financial year or upcoming years. So insurance company also takes care of all these contingencies by doing a proper actuarial, right, of its probable claims basis on their past trends, future expectations, right? So all these are taken care by India's 104 at the given point in time, right? Then there are certain contingent considerations under India's 103, right? So 103 is a business combination. So whenever a company is acquiring another company, right? So there are two parts of the consideration. One, which is paid upfront, right? For example, 100 crore deal has been agreed upon. Out of 100 crore, right? So there are two parts. 100 crore is the fixed consideration, and there is a additional consideration which becomes payable provided certain conditions are met, right? So for example, suppose A Limited acquiring B Limited, right, and agreed to pay 100 crore, right, as a part of purchase consideration. whether to be discharged by shares or cash, right? Doesn't matter. So 100 crore is the fixed consideration. Fixed, right? And then plus there is a contingent consideration, right? Which is 1% of sales for next 2 years, right? Provided sales are greater than 1000 crore, right? So if the sales exceed for 1000 crore in the next 2 years after the acquisition, then 1% of that sales is the additional consideration which is being agreed by A Limited to pay to B Limited, right? Now there is a contingency involved. If the 1000 crore mark is achieved, then only this 1% becomes liable, otherwise not, right? So on the date of signing of the contract for the business acquisition, A Limited doesn't know whether they will be able to generate 1000 crore sales in next 2 years or not. Neither the B Limited knows, right? So there is a contingency involved. So this contingency is well taken care by Ind AS 103 itself, right? So Ind AS 37 doesn't come into play, right? And then the next category is the executory contracts. So executory contracts are the normal contracts which are being accrued basis on the general accrual principle, except certain provisions needs to be recorded upfront if the contracts become onerous, right? So let's understand what executory contract means. So executory contracts are the contracts under which neither party has performed any of its obligation, or both parties have partially performed their obligations to an equal extent, right? So what does it mean? So there is a contract between A and B. For example, A is agreed to supply 1000 mobiles to B. Okay, so this is the contract. Now, A has neither supplied any mobile, B also hasn't paid anything, right? So 1000 mobiles consideration was say 1 lakh, right? So neither the B has paid 1 lakh nor the A has supplied 1000 mobiles, right? So in this case, neither of the parties have yet started to perform their respective obligations. So this contract is called as executory contracts. Or suppose out of the 1000 mobiles, 200 mobiles are supplied by A Limited and the equivalent 20,000 rupees is paid by the B Limited. So both the parties have performed to the equal extent, right? So how many mobiles I have supplied, basis on that, pro rata payment has been made by B Limited. So these contracts are called executory contracts because they are either will be executed over the timeline which has been agreed, or they will be cancelled later on. But as on today, there are no signs of these contracts becoming onerous, right? So company A is also in the process of getting it completed. Company B is also ready to perform its obligations. There are no signs of these contracts, getting cancelled or becoming executory at this point in time, right? Then what are the onerous contracts? So onerous contracts are those contracts where the present obligation under the contract shall be recognized and measured as a provision. So where the unavoidable cost greater than economic benefit, right? So for example, there was a contract entered into between A Limited and B Limited, right? Again, so A Limited and B Limited, right? Now, A Limited agreed to supply, say, 1000 silver coins, right? At agreed price of rupees, say, 1100 per coin, right? Suppose this was the contract. But by the time, contract would have been fulfilled, silver prices, rose sharply. And now it is, costing, say, 1700 per coin, for example, right? Now, in the market, if the A Limited is going to fetch the raw silver to make the coins, right? So they will be, getting the raw silver at a higher cost as compared to the price at which they have agreed to sell the coins to the B Limited, right? So in this case, A Limited, if goes further and fulfills the contract, it will incur certain losses, right? So the cost of manufacturing or the cost of producing the goods is becoming costly as compared to the selling price. So companies expecting the losses if they fulfill the contract, right? So in this case, this contract for A Limited has become onerous, right? Because if they go and fulfill the contract, they will start losing money on this contract. So what a prudent company will do in this case? Either they will renegotiate the contract with B Limited, or if the renegotiation is not possible, then simply they will try to avoid fulfilling the contract, or they will see if they cancel the contract or terminate the contract or default on the contract, what would be the penalties leviable. Suppose penalty is 5,000 rupees, right? 5,000 rupees is the penalty if any of the party defaults on this contract, so they will pay. So what A Limited will do? A Limited will simply pay 5,000 rupees and terminate the contract. Yes or no? What do you think in this case?
Yes, they can terminate
Right?
the contract. Yes.
Correct. So they will focus upon terminating the contract. So as per Ind AS 37, because this contract has become onerous. So until the contract become onerous, the contract was executory contract, correct? Because both the parties were about to perform their respective obligations. But now, because of the change in raw silver prices, the commodity which is made of the silver, in this case silver coin, is becoming costlier as compared to the price which had been agreed upon, at which the A Limited is going to sell to B Limited. So A Limited will make losses. So this is the sign, this is the situation triggered, and the contract become onerous for A Limited. So A Limited will record a provision of how much? 600 into 1,000 or rupees 500. What do you think? 5,000,
5,000.
whichever is lower, right?
Yes.
So what is the exit cost of the onerous contract? Right. So exit cost is 5,000, which is lower as compared to the fulfilling the contract. So 5,000 will be the provision which will be recorded in the books of accounts on the day the contract has become onerous under Ind AS 37. Right. So that's what the standard is saying. That measurement is at the lower of, right? So present obligation is arising in this case. Yes, because the contract has been there between the company, and there will be a provision required, right? Because there is a present obligation. Now, what is the cost of the provision? Because we need to measure the provision before recording the entry of the provision. So cost of terminating the contract or net cost of continuing the contract. So if net cost of continuing with the contract is, in this example, say 6 lakh, right? And terminating the contract is 5,000, then of course a prudent person will pay 5,000 and exit the contract, correct? Right? So this would be the provision required to be recorded under Ind AS 37. In this case, there could be many examples we will cover as we go along. If the contract can be terminated without paying any penalty, then there is a contract which will not be regarded as onerous, because at the end of the day, there wouldn't be any legal repercussions or contractual repercussions on the A Limited. So it's A Limited's wish whether they want to fulfill the contract or whether they want to escape fulfilling the contract, right? Because there are no penalties involved. So penalty is, suppose, is 0, then what would happen? Whichever is lower, again, so 0 is the lower, so no provision is required. But the standard is saying that in this case, because there is no liability on the company getting triggered by virtue of the contract becoming onerous, so better we say the contract is not onerous contract, because onerous contracts are those contracts which at least cast some responsibility on the company to obligate the contract, right? Because there are no damage clause, there are no penalties involved. So it is at the wish of the company, and hence company can simply avoid at any point in time, right? So there are no onerousness in this contract in that case. Is that clear?
Clear.
Any questions? Anybody, please? Okay. Now, let's do quick examples. An entity that operates profitably from its current leased factory relocates its operations to a new factory, right? So there is a factory which the company has taken on rent from which it was carrying out its manufacturing operations. Now it is relocating, its factory operations to the new factory, but pays the rent during the remaining 4-year lease term, right? So the lease term was for say 10 years, 6 years have already been passed. Now the company has relocated, remaining 4 years are there. But as per the contract, company has to pay or continue to pay for the rent for the next 4 years, even if the company is not going to use that space for its factory, right? So this contract has become onerous, yes or no? Yes, because it is casting a rental payment obligation on the part of the company, whether the company use that land for its factory or not, right? So this is a onerous contract. In this case, the entity is obligated to make the payments but is no longer using the asset. So the company is not using the asset, they are not reaping any benefits out of this factory land, but still, because by virtue of the contract, rentals have to be paid, right? So company has to discharge its obligation for next 4 years also, right? So this contract has now become onerous contract, correct? An onerous contract may arise in relation to the sale of commodities when the market price declines below the cost required to obtain, mine, or produce a commodity, right? So the contract which was to sell a particular commodity to another party, right, at an agreed price, but suddenly the price has fallen significantly, right, of that commodity, right? So mining of that particular commodity has become expensive, right? For example, aluminum, copper. So these are the metals which are mined. Yes or no? Yes. So if there is a contract to supply, say, copper at 500 rupees per kg, but suddenly the copper price has crashed to 200 per kg or 300 per kg. So the company which was into the contract to supply this copper commodity at a particular price now will face challenges because it will become a costly for them to mine the copper, right? Because the mining cost of the copper is only say 200 per kg, right? And the price is also in the market quoting at 200 per kg, right? Then what's the benefit for this company to mine the copper and sell it, right? So this contract will become a onerous contract for the company, right? So basically what we need to think is, in the given circumstance or situation, whether there is any signs by virtue of which a prudent person will not intend to fulfill the contract, right? So if the company or the individual, whoever is in the contract, will not intend to fulfill the contract, then we will see if if the contract is not fulfilled, what are the repercussions, what are the penalties or damages, right? So that amount would be required to be recorded as the provision if that is lower as compared to the loss which otherwise would have been incurred had the contract been fulfilled, correct? So that's the point or key learning from this. Any questions on this? Yes, no?
No question. Clear.
Thank you. Okay. So now we will talk about certain key definitions before we actually proceed with the practicals and the concepts, right? So what do you mean by a liability? So in a common parlance, what we say, liability means something which we need to pay at some date, right? So today in our balance sheet, some liabilities are sitting. So those needs to be discharged in the upcoming months, weeks, days, or years, right? So those are the liabilities. Basis the tenure, they will be divided into the long term, short term, right? So that's what we know. But the technical definition of the liability is a present obligation. So the key word is present, right? Arising from past events. So the key word is past, right? So the obligation on my part is present. And why there is obligation? Because some event has taken place in the past, right? That's why in my balance sheet, so if I'm preparing the balance sheet of say 31st March, right? So these are my assets and these are my equity and liability, correct? Now there are certain assets, PP&E, etc., right? And there is a ESC, right? And then there are liabilities. Liabilities are divided into long-term liabilities and short-term liabilities, correct? Now, within these long-term or short-term, suppose one of the liability is payable to creditor. Creditor is suppose B Limited, right? And balance sheet is of A Limited, right? Now, within these liabilities, there is a liability which is a payable to creditor B Limited. Now, why this liability has occurred and recorded in my books? Because either I have taken any goods from B Limited or any services from B Limited, yes or no? Right?
Yes. Yes.
Either I have purchased something in the form of physical goods or in the form of any services. For example, B Limited could have been providing a, uh, legal services or advertising services or marketing services, or B Limited could have been providing certain property, plant and equipment, or certain machinery, spare parts, or certain other raw material which I am using in my business, right? So whatever is the nature of the goods and services doesn't matter. The only thing matters is something I have purchased from B Limited. Yes or no? Yes. Now, because I have purchased something, so this purchase transaction is the past event or not?
Yes, it is a past event.
Right? Because this purchase has already been occurred, right? So this is a past event. Now, by virtue of this past event, I have something to pay to be limited. So this payment which I am going to make to be limited, whether immediately in next 1 week or in month or in a year or in a couple of years, doesn't matter. But can I say that this is my present obligation? So the tenure of the payment could be 1 week, 1 month, 1 year, or more than 1 year, right? So basis on that, I will classify my liability into the long term or short term, right? So I don't need to confuse with the word present with the short term liability only, right? Or the long term liability, right? So short term, long term is the classification basis on which when the payment is expected to be made or when the liability is expected to be discharged, settled, or expired, right? So that is a presentation classification. But my obligation is present obligation or not? Yes or no?
Yes, yes, it is a present
Right? Yes.
obligation.
So liability is a present obligation arising from certain past events which have already occurred. The settlement of which, so settlement of this liability is expected to result in an outflow of resources. Yes or no? Outflow of resources. So as and when I am going to settle this liability to be limited, whether I need to incur some outflow of cash. Yes. So
Yes.
resources could be cash, could be shares, right, of the company or the group company, or could be other assets, right? Whatever the assets company has, property, plant and equipment, machinery, furniture, raw material, inventory, right? So other assets could be anything, PP&E, inventory, right? Or any other assets in the balance sheet. So I can discharge this liability by paying anything which is being accepted by B Limited, right? So acceptance, no acceptance is a matter of, B Limited's decision. But there would certainly be some outflow of resources from my side in the form of cash or any other assets, right, to be limited in order to discharge this liability, right? So this is called the liability. So this is the technical definition of liability, right? Why anything is recorded as liability in my balance sheet? Because it is meeting three conditions rather. Number one, the past event has occurred. Number two, present obligation is there by virtue of this past event. And third, to settle this, obligation, there would be certain outflow of resources. So if these three conditions are met, liability will be recorded in my books of accounts. Is that clear to everybody?
Clear.
Clear. Now, there is a provision, right? So now we have understood the liability. Now, what do you mean by provision, right? And how it is different from a liability? So provision's definition is provision is a liability. So provision is a liability of uncertainty, either in terms of timing or in terms of amount, right? So liability means a fixed. I know how much I need to pay to be limited, right? I know when I need to pay to be limited, correct? So amount as well as timing, both are agreed with B Limited. So this is a clear liability. But if there is some, sort of confusion, either in the form of amount, how I don't know how much I need to pay. So, or I know the amount, but I do not know whether I actually required to pay this or not. I don't know. And if yes, when, I don't know. So either the doubt is on amount of the liability or on the timing of the liability, then this liability, which is not crystal clear as we had in our previous example, then this nature of liability will be regarded as a provision, right? So provision means a liability which is provisional and not final. So provisional word gives you the term provision. Is that clear? So this is a liability which is a final liability, right? Final liability. Correct? Because this is clear in terms of how much need to be paid, to whom need to be paid, and when need to be paid, right? But there is a liability which is a provisional liability, right? Which is not yet final because assessment is still underway to determine either the final amount or the timing, right? Something is not clear, right? That's why this is called provisional liability and not the final liability. So instead of saying long word provisional liability, we simply say provision. Is that clear?
Clear.
Now, what is the provision? Provision means present obligation from past event, right? So at least there is a past event by virtue of there is a present obligation. Plus outflow of resources is probable, right? So there is an expectation that some outflow of resources will happen in the future to discharge this present obligation, right? Plus reliable estimate can be made. Then only it will be regarded as the provision. So this is the definition of the provision. So provision means present obligation by virtue of past event plus outflow of resources is probable plus reliable estimate can be made. So if I try to correlate this definition with the above line, then provision is a liability of uncertain timing or amount. So uncertainty is related to what? Either the amount or the timing, right? And hence definition of provision says reliable estimate can be made. So if the estimate cannot be made reliably, then it means I'm not able to estimate by what amount I will record the provision. So in that case, provision will not be recorded in the books of accounts, because the very fundamental rule of the accounting framework is, in order to record any entry in the books of accounts, there has to be some amount which is reliably measured. If the amount cannot be measured reliably, then we will not record that uh, entry in our books of accounts. Is that clear? Right? So unless and until reliable estimate can be made, provision will not be recorded. Right? So provision will be estimated based on some management assumptions or past trends. Right? Suppose there is a case law going in, running in the court. Right? Now the other party is asking for a damages of rupees 1 crore from the company, right? Because they have they have suffered some health issues by consuming the company's medicine, right? So there is a pharma company sold certain drugs, and the customer who has bought that drug, got some serious side effects, right? And the customer has filed a case law against the company in the court, right? So these are the facts. Now, customer is claiming 1 crore damages against these health issues, right? Which are serious health issues, which caused because of this drug, right? Now, company is fighting the case law in the court. Court is yet to decide. Both the parties have their lawyers. Both the lawyers, are making the case favorable for their client, right? So this is the situation or scenario. Now, what do you think? Whether the company should record any provision in this case? If the answer is yes, then how much amount? What do you think?
I don't think it is a provision, because there is the outflow of resources is not probable, and the reliable estimate cannot be made. Actually, reliable estimate cannot be made.
No. So what you are saying? Provision will not be recorded because outflow is not probable, or the reliable estimate is not made, or both?
Reliable estimate cannot be made. I think outflow.
Reliable estimate cannot be made. That's what your stand is. Okay.
Yes.
Why do you think the reliable estimate cannot be made? The person who has sued the company in the court has already filed in the court the papers, for 1 crore damage, right? So 1 crore is the amount, the under the which the claimant is claiming. So why you are saying the reliable estimate cannot be made? It is clearly evident 1 crore.
It is evident, but it is not necessary that full 1 crore will be awarded in his favor.
Okay.
And outflow of resources is also not probable. Probable means if it is certain, above 50%.
Okay.
Probability.
So you are saying neither the outflow is probable nor the estimate can be measured reliably. Hence, provision will not be recorded. Right? That's what your answer is. Correct?
Yes. Yes.
Okay. In that case, is there anything you will need to do on this in your balance sheet?
Contingent liability.
Okay. So contingent, you will record the contingent liability?
No, it has not to be recorded. Maybe it has to be given as a note.
Disclosure, right? So
Disclosure,
no recording.
Yes.
Right. So contingent liabilities are never recorded. That is the thumb rule, right? So recording, if the recording is triggered, then it will be named as provision only, right? So provisions are recorded, contingent liabilities never. So in case we come to conclusion that there is no provision required, then in that case we will check whether there is any contingent liability in this case present or not. If the contingent liability is also not present, then no disclosure will be required. If the contingent liability is there, then contingent liability disclosure will be required in that case. But I am coming back to your answer. You said there is neither the outflow of resources probable nor the reliable estimate can be made, right? So number one, when I say reliable estimate, so what do you mean by reliable estimate? What the reliable estimate means? So let me expand on this. So in the given case, there is a customer who has filed a case against the company, right, in the court and asked for a 1 crore damage, right? Now, I understand that 1 crore is his ask, but possibly I may not end up paying 1 crore fully, maybe 25 lakhs, 30 lakhs, 50 lakhs, right? Or maybe some amount anywhere in between 0 to 1 crore, right? So, what I will do in order to make this reliable estimate, I will see how many such cases have been observed in the past, if there are any on the company by any such customer. Yes or no?
Yes.
Right? In that case, what was the outcome? Whether the company has lost those cases or won those cases, number one. If the company has won those cases, then even then company did any settlement payment or not, number one. If the company has lost those cases, then what were the payments made in those cases against the amounts claimed, right? If there are no cases on the company, then what will the company do? The company will do some market research on their competitors, right? So if there are any cases on their competitors which are being recorded or disclosed in the form of contingent liability by those competitors, so that data input I need to gather in order to come to reasonable conclusion if I am going to uh, uh, record this provision or not, right? So how my competitors have handled this situation, what was the outcome in their case, right, in similar situations. If that data is also not available, suppose this drug is new drug, unique drug, recently launched, no previous version of this drug was ever launched by any competitor in the past, right? Then I will simply ask my lawyer, how many chances are there of losing this case, right? Then the lawyers generally have very a relatively good idea or from their experience, right? So they know if there was any fault in the drug, right, then certainly the company will lose. But if there is no fault, right, and it is because of the wrong prescription by the doctor, right, to whom the customer had visited, actually this drug was not suitable for that particular patient, but it is generally suitable for other patients, right? So those ifs and buts, all those research, right, all those data gathering, input gathering has to be done in order to come to a conclusion. Number one, whether there is any present obligation on the part of the company. When I say present obligation means if the company loses this case, then there is a clear cut liability. But because the outcome is not yet has arisen, right? So what are the chances? So lawyer says, boss, there is some problem with your drug, right? There could be more customers getting these side effects or health issues. So the company needs to prepare or pull up its socks for recording this provision. Then I will ask the lawyer, how many chances you see? So lawyer says kind of 50-50, right? Probably you win, probably you lose. Now, in that case, present obligation arises, yes or no? Because there are chances of losing the case, equal chances of losing the case, right? Right. So there is a probability which is likely, right, that the company will lose the case. If the company lose the case, then certainly there will be a settlement payment, yes or no?
Yes.
Yes. But at today's date, on 31st March 2025, when I'm preparing this balance sheet, I do not know what will happen in the future on this case, right? And lawyers are advising me, boss, chances are, less. We will win. So in that case, there are more chances of losing, right? If the lawyers are not confident, then it means there is a liability on the balance sheet, liability on the company.
Yes. Yes.
Yes.
In that case. Yes.
Now, next step comes, we know that there is a present obligation because of this past event. Past event is the selling of that drug and consumption of that drug by the customer and the customer getting the side effect. So this is the past event. Present obligation is, lawyers are saying chances are, not good. So present obligation arisen because probability has established. Probable means more likely than not, right? What do you mean by probable? Probable means more likely than not. Correct? That is greater than 50%. Yes or no?
Yes, greater than 50%. Yes.
Greater than 50%. Now, if the lawyers are not confident, it by default means greater than 50% chances of losing the case, yes or no?
Yes.
Yes. Because my lawyers are not sounding confident, it is giving a sign of, more likely than not chances. That is more than 50% chances of losing this case. I am not saying 90%, right? I am not saying 95%, but I am saying it is highly likely that I will lose the case, because my lawyers, whenever I speak to them, they say, oh boss, this is typical. We are trying, but don't put any hope on this, right? So this is what the lawyers are saying. So it means more likely than not of losing the case. Now, the next step comes. So present obligation is established. Past events have already occurred. Present obligation is established. Now, question comes whether I can made a reliable estimate, yes or no. If the reliable estimate can be made, entry will be recorded in the books of accounts for this provision or not?
Yes. In that case, it will
Yes.
be.
In that case, provision will be recorded. Now, if I say as a management that because we have never experienced, so I am now stepping into the shoes of the management, right? And I am replying my stand on this. So I'm saying our lawyers confirm that they are still trying their best, but the chances are not, enough that this case will be decided in favor of the company, because there is a no precedent case available to refer to, right? So this is a peculiar new case. My lawyers are trying their best. Number one. Number two, on the estimate part, because again, this is a new case, we also do not know whether we will owe to pay full 1 crore, or we will be able to establish some equilibrium between 0 to 1 crore, or maybe we will prefer to do a out of court settlement with the party if the party agrees to, right? So this is the general stand management generally gives, right? Now, basis on this, in terms of reliable estimate, management is not confident how to measure this. Now, by saying this, that because we do not know how to measure this, can I escape from the recording of this liability?
No, liability cannot be escaped. It has to be
Liability
recorded.
cannot be skipped. So, but there is a condition casted by the standard that reliable estimate has to be there. If the reliable estimate is not there, then provision cannot be recorded, because this is the crucial condition. But if the management comes and say we are not able to make any reliable estimate, then this will be treated as a failure on the part of the management only, right? Because in general, in this world, at least some reliable estimate can be made for any or anything, or rather everything, right? Whatever exists in this world, right? So if the management is claiming that we are not able to estimate and hence we are not required to record the provision, so there is a failure on the part of the management. So in that case, maybe management needs to explain in the disclosures in a detailed manner that this was the facts of the case, this is the probable outcome of the case, this is the demand by the party, and because of absence of reliable estimate, we did not record this liability in our books of accounts. Had we recorded this liability by say 1 crore, then our profit and loss will have come down by 1 crore, our EPS would have come down by this much amount. So those additional disclosures needs to be given in the statements. And why the reliable estimate cannot be made, the reason for the same has also required to be given, right? So instead of going into that nitty-gritties or detailed disclosures, and certainly these sort of disclosures will give a negative impression in the eyes of the users of the financial statements, like investors. So investors will start believing that management is not very sharp, management is not having a grip on accounting matters, right? So generally companies try to avoid to say to come out and say that something is not measurable reliably. So in practical life, everything is generally measurable reliably, right? So this condition is always deemed met. Are we on the same page what I am trying to convey?
Yes, yes.
Right? In examination life, so there are two things in practical life, in examination life. In practical life, we have time, we have resources, we have management. We can question management or question other third party experts as well to come and arrive to certain conclusions, right? All those R&D can be done in practical life. But in examination life, basis on the limited facts given in the question, we need to decide upon purely basis on the literature, right? So literature says three conditions: present obligation out of the past event, met; outflow of resources probable, met because lawyers are not confident; reliable estimate. Now, if in the examination basis on the facts, it is evident that a reliable estimate cannot be made, then our answer would be because of the failure of the condition of the reliable estimate, provision will not require to be disclosed. However, the additional disclosures gets triggered, right? But generally reliable estimate can always be made in the practical life, right? This is very rare that somebody comes and says that we are not able to estimate something. Is that clear? So generally the third condition, reliable estimate can be made, is treated as a deemed met condition unless and until we are ready to challenge it on some grounds. Clear?
Clear.
Anybody wants to ask anything on this? Okay, so let's do this question. ABC Limited is an automobile component manufacturer. The automobile manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty, right? So ABC Limited is doing what? They are manufacturing certain components and supplying to a Maruti, for example, right? Maruti is the auto manufacturer. Now, Maruti has entered into a contract with ABC Limited along with a specified delivery schedule, right? On which particular dates items needs to be delivered. Non-adherence to this delivery schedule will result into a penalty on the part of ABC Limited, which ABC Limited needs to pay to the Maruti. Is that clear? Now, as on 31st March 2001, the reporting date, the manufacturer has a delivery scheduled for June 2002, right? So in June, some delivery needs to be made. I am preparing the financial. ABC Limited is preparing the financials for 31st March 2001. However, the manufacturer is aware that he will not be able to meet the delivery scheduled in June 2020, 2002. Determine whether the entity has a present obligation as at 31st March 2001 requiring the recognition of the provision. So in nutshell, the question is whether ABC Limited needs to record any provision in the 31st March 2001 financials, knowing that they will default on a delivery or the delivery is becoming tight to be delivered by June 2002. And if the delivery is not made on time, then there will be a penalty levied. Now, the question is, provision is required in 31st March 2001 books or not?
No, provision cannot be made.
Mm-hmm. Why? suppose I'm giving the amount of penalty 50,000. Okay. Now, why provision cannot be made? What's the reason?
Manufacturer already knows that he will not be able to meet the delivery schedule. So the present obligation is not there. There is no present obligation.
There is no present obligation. Why? Why there is no present obligation? Anybody? Please try to answer. Others? Okay. See, I told you that present obligation has to be because of past event, right? Now, in this case, what is the past event? What is the past event in this case? None. There is no past event.
There is
right?
no past event here.
There is no past event. There is no delivery defaulted yet. Unless and until there is a default, past event is not there, right? Because past event is not there, so there can never be a present obligation, correct? Because goods are scheduled to be delivered in June, which is after the year end, right? So there cannot be any delay as at 31st March, yes or no? Because there is no delay as at 31st March at least, right? So there is no past event in this case, yes or no? Because there is no past event, so there is no present obligation. Because there is no present obligation, so there is no provision, correct? Clear?
Correct. Clear.
So let's do some examples of past event now. In respect of a warranty provision, what would be the past event? The original sale, right? So if the Tata Motors has sold the car, then only the warranty provision past event has been met. Unless and until the car is sold, warranty provisions doesn't get triggered, yes or no? So warranty provisions become effective only when the car is sold. So only when the product is sold, then only warranty provision under the contract becomes effective. So for the warranty provision, the past event would be the sale of the product. In respect of contamination of the land, it would be the original contamination, right? So if any company is doing some mining operations, or setting up some plant, or setting up some oil rigs to extract the oil from the ground, right? So the land gets contaminated in that case. So unless and until the company has actually digged on that land, started its factory construction, the land is not contaminated. So for the contamination of land, it would be the contamination itself, right? Unless and until the contamination is there, we cannot say that contamination obligation arise. In respect of provision for dismantling or cleaning the oil rig, it would be the installation of the oil rig, right? Ind AS 16 PPE. Studied or not?
Yes, studied.
So you must have studied under Ind AS 16 the dismantling provision for restoration of site, provisions for dismantling of the factory in the future, right? Needs to be
Yes.
recorded. on the day
Yes,
one and
yes,
added to the PP&D and depreciated? Yes or no?
yes, yes.
Right. So what entry you were
The
passing on the day
present
one?
the present value of this dismantling amount has to be added.
PP&D to provision for contamination, oblique dismantling, oblique restoration, right, of site. Correct. So this item was the present value of liability to be paid after 20 years, 15 years, whatever the case. Correct.
Yes,
And
correct.
this present value should have been capitalized to the PP&D, yes or no?
Yes, I
And
did.
depreciated over the useful life, yes or
Yes,
no?
yes,
Right. So this you must have already studied, but India 16 was dealing with only this leg. Correct.
correct,
How
correct.
this provision is getting recorded in that entry by virtue of India's 37. Yes or no?
Yes, right.
Right. So India's 37 advises us to record a provision, right? And that provision is the liability side entry, which is being recorded, right? Asset side is taken care by India's 16. So India's 16 says that this needs to be capitalized in the PP&D. So that's what India's 16 says. But how this will be computed and recorded as a liability or the provision, that is governed by India's 37, right? The government introduces, let's do an example. The government introduces a number of changes to the income tax system. As a result of these changes, an entity in the financial service sector will need to retrain. So they need to do the training sessions for the large population of its administrative and sales workforce in order to ensure continued compliance with the regulation. At the end of the reporting period, no retraining of the staff has yet started or taken place. It is assumed that reliable estimate can be made of any outflows expected. So, because event has not yet taken place, so no past event, so no present obligation. Correct? Unless and until the event takes place, present obligation cannot be there, even if the outflows are expected. Reliable estimate can be made, doesn't matter. The crucial condition is past event. Past event has to be there, because of which present obligation will arise, right? So in this case, what will happen? There is no obligation because no obligating event retraining has yet taken place, so no provision is required to be recognized. Is that correct?
Correct.
Correct. So whether we record the purchases before making the placing the order or after placing the order and receiving the goods.
After placing the order and receiving the goods.
Correct. So past event has to be there now, first of all. Otherwise, I will say I am planning to purchase something in 2027. Let's record that purchase today and create a liability. Cannot do, right? So past
Right.
event means the event because of which the liability is getting accrued or arise, right? So past event is expenditure on the retraining of the staff. So in order to incur that expenditure, I need to contract with some third party, education company who is coming and, started delivering these lectures. So as and when I enter into the contract with the company to start, taking these sessions with my employees, right? Then only I will, record a provision because nothing has yet been done. So no provision, right? Otherwise, so all the next year transaction, next to next year transactions, anticipated transaction will also comes into the recording purview. Correct? So what do you understood by a provision? So provision means a liability of uncertain, either the timing or the amount, right? So this is what the definition of the provision is, which we have understood so far by now.
Yes. Yes.
So what all we have understood until now uh, is, summarized in this chart. So whoever masters this chart, right, will always be clear when and how and when provision needs to be recognized. So let's try our hands on this chart and try to crystallize the concepts. So provision will be recognized basis on the below tree. So these are the questions which we need to ask ourselves and answer basis on the facts or the information we have, right? Is there a present obligation, legal or constructive, for an entity? If the answer is no, no present obligation, provision will not be recognized, correct? If the answer is yes, has the present obligation occurred as a result of past event? If the answer is no, provision is not recognized. If the answer is yes, then next question, is there a probability that outflow of resources will be required to settle the obligation? If the answer is no, then provision will not be recognized. If the answer is yes, then can the entity make an reliable estimate? If the answer is no, provision is not recognized. If the answer is yes, then only the provision will be recognized. Correct? In practical life, this condition is generally considered to be met. Right? Because no company can come and say that they are not able to measure the amount. Right? Correct? This is what we have understood by now. Now,
Yes.
there are two types of, obligating event. Obligating event which are in the nature of legal, right? Which cast some legal obligation, or some are constructive, right? So in this chart as well, we saw that present obligation arises either because of legal event, legal, parameter, or from the constructive, right? So what are these? What obligating event means? First of all, an obligating event is an event that creates a legal or constructive obligation on the entity that results in an entity having no realistic alternative but to settling that obligation, right? So either by virtue of any law, or by the contractual obligation, or by virtue of expression of the company, right, an obligation gets established on the part of the company, which ultimately will be settled only, right? So what do you mean by legal obligating event? Legal means either they are contract driven, right? Because contracts are, legal documents as and when they are signed by both the parties, correct? One party can sue the other party in the court of law basis on the signed contract, yes or no? Yes. So if there are any contractual obligations, then those fall within the legal, uh, purview, or by virtue of any law, right? State law, central law, whatever the laws and legislations are there in the country, right? So either it is because of the contractual obligation, or it is because of any law which is there, or which has recently been notified by the government, right? So these are called legal obligations, legal obligating event. And what are the constructive? Constructive means established pattern of the past practices. Suppose you are going and buying a product from a particular vendor, right? And you generally have experienced that, if you are not happy with the product, the vendor generally replaces the product, or even, returns the cash, right? So this is the past established practice of that vendor, right? So vendor here, what vendor is doing? So vendor is setting some expectations on their customers that if they are not happy, the vendor is okay to replace the product or even return the cash, correct? So this is a constructive obligation, although you have not entered into a specific contract with the vendor that if I am not happy, I will return and you have to pay or return my money, right? Or if I'm not happy or the product is not meeting the quality standards, then I will get it replaced from you, or I will get it repaired from you, right? So those are the constructive obligations only, right? So even then, because by virtue of the past practices or established, past actions of the company, there are certain expectations the customer has on the part of the product quality, right, from the vendor. So these are called constructive obligations. Published policies. Any company has published something on its website. Does that mean a legal obligation? No. It is again a constructive obligation, right? So this is a published policy on the website, on the notice board of the company, that if the customers are not happy, they can return the product within 15 days of the purchase, right? So this is not again contractual. This is only a published policy, right? Subject to T&C. T&C are written in brief, right? Sufficient specific current statement, right? Suppose company generally does not establish any past practice, but while making the contract, they have assured you that product is of best fit, best quality, blah blah blah, and they have assured you. Now you are not finding the product good enough, and you are asking the company to exchange or repair, right? So certainly the repair cost will be incurred by the company, right? So if company has specifically assured you of the quality standards about the product, then this is also a constructive obligation. Although they have not entered into a contract or agreement with you that in case you are not satisfied, we will incur the repair cost and get the product repaired, or we will exchange the product, or we will return the money. They have not specifically said that. They only assured you that product is of best quality, right? Still, they are casting a constructive obligation on themselves, right? So these are the nature of the constructive obligations. So let's do an example. X Limited entered into a contract with Y Limited for the supply of some material as per the terms of the contract. In case of the breach of the contract, the party who breaches the contract has to pay 50 lakhs to the other party. X Limited breached the contract with Y Limited. Now, in this case, obligating event is what? The breach of the contract, yes. So breach of the contract is the past event, yes or no? Yes.
Yes.
By virtue of past event has already been occurred, that is the breach of the contract, there is an obligation clause gets triggered to pay 50 lakh as damage to the other party, yes or no? Yes. So obligating event in this case is the breach of contract, which is triggered by a clause written in there within the agreement, and hence it will be a constructive obligation, correct?
It would be legal obligation.
It will be legal obligation because this is specifically a clause written in the agreement that if any party breaches, it will pay 50 lakh to the another party. So there is a legal obligation in this case, right? So by virtue of this event, that is the breach of contract, which is a past event, and because past event has occurred and the obligation clause is triggering, so this past event has taken the form of an obligating event. Now to classify this obligating event in either of the category, that is the legal or constructive, we will see whether it is there in the contract or not. Yes, it is there in the contract. So by virtue of the contract, it is a legal obligation, correct? X Limited is engaged in the manufacturing of the fertilizers. Effluents discharged in the manufacturing processes have polluted the river near the manufacturing plant. The residents of the nearby locality launched a massive agitation against the pollution. So companies dumping, the leftovers of a fertilizer into the nearby river, and the nearby, people who are residing in that area are doing a massive agitation against the company, right? X Limited agreed to their demands to reduce the water pollution by installing the necessary effluent treatment plant. However, during the year, no steps are taken to install the plant. No legislation is there in the country which requires company to reduce the pollution in existence. In this case, there is no law, but by promising to take steps to reduce the pollution, X Limited has created a valid expectation on the part of the public that it will discharge its responsibilities. So the obligation in this case is a legal obligation, correct?
Constructive obligation.
Constructive obligation, because company has not entered into any contract with these people, right? And there is no law. So neither there is a law nor there is a contract. So legal obligation cannot be there. But because the company has understood the sentiments of the people and they have assured them that, okay, they will do something to reduce the pollution. So they have created a constructive obligation in this case. Correct? So the obligating event is the constructive obligation. Now, how many of you believe what is the past event in this case? If there is any. What is the past event?
If effluents discharge in the manufacturing process.
So, no. Effluents discharged in the manufacturing process is not the past event. Those effluents dumped into the river is the past event. Correct? So, if they were not dumped into the river and they were, taken care otherwise, and river was not affected, then there wouldn't have been any past event. Correct?
Right.
So dumping of the leftover of the fertilizer manufacturing, leftover effluents into the river is the past event. Now, river is getting polluted, yes or no? So getting the river polluted is the past event rather. Correct?
Correct. Right.
Correct. Now, past event has occurred, yes or no? Yes, occurred. Right? There is a law in place? No. There is a contract in place? No. But there is a assurance. So assurance is creating a constructive obligation on this past event. Correct? An entity has prepared a formal plan for a reorganization involving site closures and redundancies. The plan has been approved by the board at the year end, but the entity will not implement or announce the reorganization until the year end completed. So after the year end, company will announce, but until 31st March, the company has not yet announced the plan. Now, in this case, there is no constructive obligation, even if there is an announcement after the entity's year end, but before the financial statements are approved. Why? The announcement is a non-adjusting post-balance sheet event. Ind AS 10 already done. Adjusting event, non-adjusting event.
Yes,
right?
Yes.
Right. So what that standard says, if something is coming after the 31st March, but before the approval of the balance sheet, right? So those events, subsequent events, are to be categorized into two categories: adjusting, non-adjusting. Correct?
Adjusting and non-adjusting. Yes.
Correct. Now, if the event is a non-adjusting, then do you do any accounting in the financial?
No accounting is done. Only disclosure.
So for non-adjusting events, only disclosure is required. And for adjusting events, accounting is required, yes or no?
Yes.
Yes. And what are the adjusting events? Adjusting events are those events for which there were
conditions existed on the balance sheet.
Conditions existed as on the balance sheet date, right? So conditions were there on the 31st March, but they are confirmed after the year end, but before the approval, right? But conditions were there. Fire broke on 31st March. Adjusting, non-adjusting?
On 31st March?
Yes.
Adjusting, yes.
Adjusting. Fire broke on 2nd of April?
Non-adjusting.
Non-adjusting, right? So, debtor defaulted on 31st March. Adjusting, non-adjusting?
Adjusting.
Adjusting. Debtor defaulted on 2nd of April?
If the conditions were existing at the balance sheet date, then it will be adjusting.
Correct. Now, how we will check that? Whether the debtor's credit worthiness was already degraded during the year end or not, or something has happened on 2nd April itself, right? Which made the debtor defaulted. Correct. So that needs to be seen in that case. So we try and investigate whether the conditions were existing on 31st March or not, in order to come up with the conclusion whether the event is adjusting or non-adjusting, that you have studied under Ind AS 10, right? events accruing after the balance sheet date, correct? That's the name of the standard. Now, for the purpose of Ind AS 37, because we also are encountering with such obligating events, right, which may occur on 31st March or later after the year end. So again, we need to do some harmonious interpretation between the Ind AS 37 and the Ind AS 10. That's what we are trying to do in this example, right? So in this case, what the company was up to do. So the company was up to do announce a restructuring plan within the company, right? But company has not announced it by 31st March, right? Because the company has not announced by 31st March, but company management was intending to do some restructuring. Now, how many of you believe just because of no announcement, indicators, conditions were there on 31st March? Try to come up with your logic. What do you think in this case? If the announcement was made on 31st March, then would you say that adjusting event is the adjusting event, right? Or if the announcement was not made, then you say it is an adjusting event for any reason.
Yes, since the announcement was made, it would be adjusting event in that case.
Okay. Should I say, even if the announcement was made on 31st March, then it would be a non-adjusting event? Can I say this?
Yes, yes.
Why?
Because the announcement was made after the balance sheet date.
No. I'm saying announcement is made on 30th March, one day before the 31st March. Okay, 30th March, management announced that they are going to do a restructuring within the organization. Now, what do you think? Whether whether any provision is required in the balance sheet for this or not?
Yes, it is an adjusting event in that case.
No. So under Ind AS 10 as well, you must have studied this case. I'm not sure whether it was discussed or not, but we have to be very clear. Mere intentions of the management to do something will not tantamount to a past event, right? So if the management is only announcing that they will do some restructuring, it doesn't mean that something has changed now on the ground until the management started implementing that restructuring plan by taking some action. Now, what do you mean by action? So action means company started preparing the list of employees who will be laid off because of this restructuring, and already starting communicating to those employees that because you will be laid off in next 3 months or next 6 months, so let's come to a table and negotiate what we need to pay to you, right? So this action has been initiated. This email has already been rolled out to the employees, right, seeking their responses. So it means the action is implemented. It is not a mere intention. Actions on the ground have started. So unless and until the actions on the ground have started, there wouldn't be any past event. Because there is no past event, there wouldn't be any present obligation. Is that clear?
Yes, clear.
Clear. So we have to be very clear about the concept of the past event first. Unless and until there is a past event, there cannot be any obligation, whether legal or constructive. Because there cannot be any obligation, so there is no question to record any provision. Is that clear?
Clear.
Our focus should be to identify the past event. If the past event is there, then only we will try and find out what is the obligation, whether that obligation is legal or the constructive. If it is a legal, then what are the repercussions? If it is a constructive, then how much provision the company is going to record? So all those questions comes at a later stage. Unless and until we find the past event, we are not going to record any provision in our books of accounts. That is the thumb rule, right? Now, the past event means something concrete have occurred. Mere intentions of doing the restructuring within the company doesn't tantamount to a past event, right? Even if it is announced. So announcement also is making no change. Mere announcement is nothing. unless and until by virtue of that announcement, some implementation on the ground has already commenced. Is that clear?
Yes, clear.
So what the constructive, or in this case, a constructive obligation would exist if the entity has raised a valid expectation in those affected by beginning to implement the reorganization by the end of the year. For example, by scrapping the plant, informing the employees about their laid off plan, informing the suppliers that they are not going to purchase raw material anymore from them. So let's try and settle the dues despite the absence of a formal announcement. So even if the announcement is not there, but actions are started, in that case, constructive obligation arises. Right? Now, what are the thumb rules? Thumb rule number one, past event has to be there. Very important. What past event is? In this case, implementation of the restructuring plan, even if not announced. So even if the management has not announced it formally, but they have started negotiating with their vendors, they have started negotiating with the proposed employees who will be laid off, right? They have started finding out a new factory area, and they have already started negotiating with the current landlord of the current factory that they are going to surrender their land or return their land in near future, right? But they have not yet formally announced this plan, right? So announcement doesn't matter. What matters is action on the ground, right? Basis on the action only, we will say whether there is a past event or not. If we say there is a past event, then we will say whether there is a legal obligation or constructive obligation. In either case, there would be a provision. Is that clear?
Clear.
A retail store has generally known policy of refunding the purchases by the dissatisfied customers, even though it is under no obligation to do so. In these circumstances, the sale of the product gives rise to a constructive obligation because the entity, through its reputation for providing refunds, has created a valid expectation on the part of the customers that a refund will be given if they are dissatisfied with their purchase. Correct? So, although there is no contract, whereby the company has entered into to return the money if the customer is not satisfied, but they have created a valid expectation by doing such actions in the past, so this will be regarded as the constructive obligation. Correct? Okay, so let's have a break now for 10 minutes. 8:35 is now. Let's return by 8:45. Is that fine?
Yes, fine. Okay.
Okay, thank you. Thank you. So we were talking about when we before going on the break about the past event and present obligation, right? So we will do one more example to understand it better. So let's do this one, because more examples we do, more the concept gets clear. Under the new legislation, an entity is required to fit smoke filters to its factories by September 30, 2001, right? So legislation is there, which is recently notified by the government, which requires the companies to fit the smoke filters, by 30th September 2001, right? The entity has not fitted the smoke filters. It is assumed that a reliable estimate can be made of any outflows expected, right? So the third condition, the reliable estimate is assumed to be met in the given circumstances. Now, situation one, as at 31st March 2001, the company is preparing its financial statements for the year end 2001, right, which is the reporting period. Now, whether there will be any present obligation in this case? No, because there is no past event, right? There is no obligation because there is no obligating event, either for the cost of the fitting smoke filters or for any fines under the legislation. Why? Because the deadline given by the legislation is 30th
30th September.
September. And we are preparing for the financials for 31st March year end, right? So by 31st March, even if the company has not fitted the smoke filters, they have still 6 months to go, right? So penalty cannot be levied under the legislation, right? So there wouldn't be any past event, right? That is the default of the legislation. So default of the legislation would be the past event. That default not yet occurred because still 6 months to go to the to comply. Yes or no?
Yes.
Now, whether the smoke filters, requirement, even if there is no requirement under the law, then the cost of the smoke filters is also not required to be accrued, right? Because the company has not initiated any action on getting the smoke filters fitted, correct?
Correct.
So neither the company has initiated any action to get the smoke filters fitted, nor there is legislation default by the 31st March. So no past event, neither in terms of getting the vendor onboarding for the fitting of the smoke filters, nor in terms of default with any legislation, right? So because there is no past event, so there is no present obligation. Because there is no present obligation, so there is no provision requirement as at 31st March 2001. Is that clear to everybody?
Yes, clear.
Right. Situation 2, financials for 31st March 2002. Now, in this case, what do you think? If the company has not fitted the smoke filters, then company has not taken any action on getting the smoke filters fitted. So there is no past event, at least in terms of getting the smoke filters fitted cost, right? Fitting cost, right? But company has defaulted on the legislation by now. Yes or no?
Yes, they have defaulted on legislation. Yes.
Right? Because they have defaulted. So getting this default or making this default for the year end is a past event.
Yes.
And this past event is a constructive obligating event, correct?
It's a legal event.
It's a legal obligating event. Why? Because there is a legislation in place which is requiring the companies to fit the smoke filters by 30th September, which the company did not fit, and hence they have defaulted on this law. Default on law is a legal obligation, right? So in this case, past event is default on law, and because it is arising by virtue of default on law, hence it is a legal obligation, legal obligating event, right? So in this case, no provision is recognized for the cost of fitting the smoke filters. That's right, because company has not initiated any action. But there is a provision required to be recognized in the books for any fines and penalties which become payable because the company has defaulted on the legislation requirement. Now, there is a past event default. That past event is a legal obligation, so legal obligating event. Hence, it is resulting into a present obligation to pay the to record the provision. Now, provision will be recorded at the reliable estimate of the amount which will eventually be paid. Right? What would that reliable estimate be in this case? So, in this case, the reliable estimate will come from the law itself. So, if there are any section within that law which talks about the amount of penalties and the fines which are payable by the defaulters, then that very amount will be considered for recording this provision, yes or no?
Yes.
Yes. If the law doesn't specify, right, and law simply says it is subject to the best judgment of the government officer, right, then government officer will tell the amount. Now, because law doesn't specify amount explicitly in the law itself, it simply says it is subject to the best judgment of the assessing officer of that very law, right? Or the officer, government officer, who will be imposing the penalty on the company. Now, because we are preparing the financials of 31st March 2002, now how the management will estimate in this situation? What do you think? So, option one, management goes to that officer that, sir, maybe you are not aware, we are the ones who have defaulted. Although we have not received any notice from you, but because we are preparing the financial statements for 31st March 2002 and our auditors have asked to provide for this provision, right, which we had not provided, and they are not ready to sign our balance sheet. So can you please issue a notice to us? Should we do this?
No.
No, of course no, right? So what we will do in this case?
Best judgment estimation by
So
management.
maybe what we will do, we will see whether any such notices have been issued by the officers on any other companies or who have defaulted on this law. If there are any, and those companies have provided for that in the form of disclosure in their notes to accounts, then certainly we will refer to that. If there are none, then certainly we will take a legal opinion from some reputed lawyer in that law, right? The lawyer who is practicing in that very domain, right? So we will seek his best advice, right? And suppose if lawyer says, oh, this law is very new, so I also cannot give you a clear idea, but in the past in similar laws, generally 5 lakh was the amount the penalties were imposed, right? Then should we go and add and record a provision of rupees 5 lakh in that case? Yes.
Yes. Yes.
Correct. So this should be the our approach, right? Certainly, we will not go to the officer. Correct.
Yes. Of course not.
Right. Let's do this one. A furnace has a lining that needs to be replaced every 5 years for the technical reason. At the end of the reporting period, the lining has been in use for 3 years. It is assumed that reliable estimate can be made of any outflows expected. Present obligation as a result of past obligating event. No present obligation. Why? So there is a furnace in which some component name is lining, which generally gets replaced every 5 years because of the wear and tear issues, right? So when the new lining was installed, it's been 3 years have already been passed. Now the 2 years are left. Now company is expecting a outflow in next 2 years, right? So what do you think? Company need to record any provision now?
No, not in this year.
Then in which year?
At the end of the 3 years, third year.
Which year?
End of third year.
So end of third year, we are already sitting now.
Uh,
So it was a cycle. Year 1, year 2, year 3, year 4, and year 5, right? So we are sitting here, right? At the end of the year 3, the company is planning to record a provision because they are expecting some outflow anytime in the next 2 years, right? For this furnace getting replaced. Now, what do you think? Provision is required or not at the end of the third year? Okay, forget about today's standard. Let's uh, go back and try to recall the India 16 property, plant, and equipment. What does that standard says? Componentization, that we are going to record the property, plant, and equipment basis on the componentization approach, right? Each component has a different useful life, and hence that very component needs to be depreciated over the respective useful life. Yes or no?
Yes. Yes.
Yes. Now, in this case, are you able to call that in this case India's 37 actually is not applicable, rather India's 16 will become applicable?
Yes.
Yes or no? So in the examination, if such question comes in where the standard number is already not given in the question, that which standard the question relates to, then it is onus lies on us to identify that whether the question is related to India's 16 or related to India's 37 or some other standard.
Yes, it is on us.
Right? It's our onus. So I only advise you to practice more and more such questions, right? And try to understand what is the trigger in the given facts, which basis which we are able to quickly identify which standard is becoming applicable in this case. So as soon as you were reading this paragraph, right, a furnace has a lining that needs to be replaced every 5 years. Bus, that's it. This line itself is saying a lot. Yes or no?
Yes.
What are the recognition criteria for India 16?
That the future economic benefits is probable and the cost can be estimated reliably.
Two criteria. Number one, number two. Future economic benefits, right? For
Yes.
more than one period. Yes or no?
Yes.
Right?
And the
Probable to hai
cost.
hi. Agar,
Yes.
so if it is not probable, then doesn't mean anything, right? So probability is definitely there, but for more than one period, right? So if the future economic benefits are expected to accrue or arise within the same year, then it is a PPND or no?
No.
No. So the condition under 16 is future economic benefits for more than one period, right?
Right.
Right. And second condition,
Cost can be estimated reliably.
cost can be estimated reliably. So this condition I generally say deemed met.
Deemed met. Yes.
Deemed met generally, right? Unless and until there is a specific peculiar case or challenge to that, right? Generally deemed met. So the only one condition I can say
Yes.
future economic benefits for more than one period. Now, what this line says, a furnace has a lining that needs to be replaced every 5 years. So as soon as we read that the useful life of this lining is 5 years, so it means the future economic benefits of this lining within the overall plant and machinery, which is furnace, is expected to arise to the entity over the period of 5 years.
Yes.
Yes. So does that line even itself means that it is talking about PPND?
Yes.
And as we are able to identify now that it is talking about PPND, so we immediately start thinking around India's 16 as well in conjunction with India's 37.
Yes. Yes.
Correct. So that's the process which should start in your mind as and when you are reading the facts, right? So if, and this comes with the practice, right? You need to practice much more lot of situations, right? So that as and when you start reading a fact, immediately, your mind works and filters down to a particular standard who is actually relevant and applicable, right? And this is a process, right, which you need to pass through, right? Otherwise, you will continue to read the facts again and again in the examination and ending up spending more time than required on a particular question, right? Now, next line says, at the end of the reporting period, the lining has been in use for 3 years. So it means over the period of 5 years, we are sitting where? Here, at the end of the third year. It is assumed that a reliable estimate can be made of the outflows expected, right? So company knows that by the end of the year 5, how much amount we need to incur, right? That is new lining needs to be purchased from the vendor and installed. So what is the cost of the new lining? That is easily available from the vendor quotation. And what are the installation charges? That is also easily available from the contractor. Summation of the two will be the cost outflow. Yes or no? Yes. Now, in this case, whether there is a present obligation. Now, let's think through from the Ind AS 37 angle now. So Ind AS 37 says there has to be a past event. What is the past event in this case? Is the lining replaced? No. Correct. Is the lining order has been initiated by the company?
Not initiated, no.
No. Is the company has announced that they are going to initiate, the replacement of lining, and they are inviting the quotations? No. Right. So nothing has already been done. Number two, even then, even if the company has announced the replacement of lining, even if the company has asked for the quotations, because the company doesn't want to wait for 5 years, they are planning before the end of the fourth year itself, right? From which vendor we will purchase as and when the lining needs to be replaced. So they are just doing a proactive approach. So even then, do you think that any past event has occurred? No. Right? So in this case, this is not the question of Ind AS 37 at all. So this is the question, example or question of Ind AS 16 only, where at the end of every 5 years, the accounting will happen. What accounting? Old lining will be scrapped, new lining will be installed. So as and when the new lining is installed, entry would be PP&D account debit to bank account, the cost of the new lining. Yes or no?
Yes. PP&D and bank to bank.
PP to bank. And for the old lining, what will happen? So the WDV of the old lining will be credited.
Yes, credited.
And some scrap account will be debited, right? Scrap account to old lining. Or if it is also sold at the very same time, then simply bank account to old WDV.
Right.
Correct? So no question of Ind AS 37 in this example, right? Cost of lining is a componentization which is a cost under Ind AS 16 and 16. Was capitalized. Now after the end of the 5 years, it will be replaced, correct, and depreciated over the 5-year period again, correct?
Yes.
Perfect. Let's do this one. An airline is required by law. Okay, here by law, the requirement is getting triggered to overhaul its aircraft once every 3 years. It is assumed a reliable estimate can be made of any outflows expected. What do you think? What should we do in this case?
Again, Ind AS 16 will come in picture.
So again, Ind AS 16 will come into play, right?
Yes.
What we need to do? This overall cost initially incurred was capitalized and depreciated over the 3 years.
Yes.
Again, now after the 3 years period, again the overall cost will be incurred and will again be capitalized. Correct?
Correct, yes.
Just by virtue of this getting driven by law makes any difference? No. Right? So in the previous example, there is no legislative requirement, right? companies replacing the lining in every 5 years so that furnace runs on its best capacity. Correct? And in
Yes.
this case, the requirement is being triggered by virtue of law, right? So whether it is getting triggered by the management decision or by the virtue of law makes the selection of India's different. No. So we will not go by the nature of the requirement, whether it is contractual driven, management action driven, or legislative driven. We will simply see what is the nature of the transaction, right? Here the nature of transaction is the incurring of the overall cost for the aircraft over a period of 3 years. So it means future economic benefits for more than one period. So hence India 16 condition is met, right?
Right.
Let's do this one. X Limited shipping company is required by law to overhaul its shipping fleet once in every 3 years. The company's finance team was of the view that recognizing the cost only when paid would prevent matching of revenue earned all time with certain cost of large amounts which are incurred occasionally. Thereby, it has formulated an accounting policy of providing in its books of account for the future cost of maintenance, that is overall or annual inspection, etc., by calculating a rate per hour sailed on sea and accumulating a provision over the period of time. The provision is adjusted as and when the actual expenditure is incurred. Whether the accounting policy of X Limited Shipping Limited is correct?
No, it is incorrect. India
Why?
16 comes into play.
Again, India 16 will come into play. The original cost will be capitalized and depreciated over the period of 3 years, as and when the new cost is incurred. So again, that will be capitalized and will be depreciated over the useful life of that, right? Going forward. So hence, no provision is required, and company has recorded a provision, so no provision is required. So provision will be reversed, right?
Yes.
Correct.
Yes.
So
Correct.
these are the questions I have just brought in so that you get a flair of how to identify a particular situation is actually getting covered under India's 37 or not, right? If India 16 situation I wouldn't have discussed, then probably some of you might end up thinking about recording a provision in this case. Correct?
Yes. Yes. That was right.
Correct. Let's do this example. An entity in a oil industry, for example, Reliance, ONGC, etc., having a 31st March year end causes a contamination but cleans up only when required to do so under the laws of the particular country in which it operates, right? So they do a oil extraction from the land and the sea, but they clean up if they are required by the law, right? If the law requirement is not there, they don't do the cleanup and they leave the land or the sea contaminated. Okay, so that's the situation. One country in which it operates has had no legislation requiring the cleaning up, and the entity has been contaminating the land in that country for several years. As at 31st March 2001, it is virtually certain that a draft new law requiring a cleanup of land already contaminated will be enacted shortly after the year end. So, companies preparing the financial for 31st March 2001, and after the year end, the law will be enacted. But on 31st March, it is virtually certain because the draft is available, right, of that law. It is assumed that a reliable estimate can be made. So third condition standard facts of the question are saying is met. What do you think? Present obligation of past event or no present obligation?
Yes. There is a past event of
There is a past event.
contaminating the
What is the
sea.
past event? That land has
Contam-
been contaminated. Correct?
Contaminated. Yes.
So that is a past event. Now, that event has become obligating because of a law being enacted. If the law was not there, then there wouldn't have been any present obligation, even if there is a past event. Yes or no?
Yes, yes.
right? But because the law has been enacted or expected to be enacted after the year end, but it is virtually certain that the law will be enacted. So on 31st March 2001, although the law is not yet actually enacted, but it is virtually certain that it will be enacted, right? So what do you think by virtually certain here? Virtually certain means it is a definitive or not?
Yes, it is definitive.
It is definitive. Now, on 31st March, it is definitive that law will be enacted, requiring the cleanup, right? But that law is not yet enacted. Law actually gets enacted on 10th of April, right? Now, let's go back to which standard? Ind AS 10,
Yes,
are
yes,
just
10.
events occurring after the vanishing date, right?
Yes,
So law is getting enacted on which date? 10th of April.
yes,
Yes or no?
yes,
So event has actually taken place on which date? 10th of April. But this event is an adjusting event or not? Yes.
yes,
Why?
yes, yes,
Why? Because conditions were there. So on 31st March, draft was available and talks were ongoing that this law will be enacted soon, right? And when we contacted the lawyers and the community who deals with those laws, they say, boss, just parliament approval is pending. Everything is done. Maybe in a week or so, or in a 10 days, or in a month, you will get the law enacted. So it means it is a virtually certain, yes or no?
yes,
Yes. So conditions were there on 31st March. Yes. So conditions were there. Event occurred. That is law enacted on 10th of April. So by virtue of India's 10 as well, it is adjusting event. Yes or no?
yes,
Yes. So India's 10 says it is adjusting event. And here under India's 37, past event is what? Contamination. That is already done. Satisfied. So condition number one, past event occurred. Yes or no? Yes. Condition
yes,
number two, present obligation because of this past event arise. Yes or no? Yes. Probable
yes,
outflow. Right? Estimate fact says can be measured reliably. Third condition is also met. So provision will be required to be recorded for these costs or
yeah,
not?
yes, provision is required.
Okay. So provision of what? Provision of the cleanup or provision of paying fines and penalties for not doing the cleanup? What do you think?
Clean up, clean up.
Cleanup, right? Because default is not yet made, right? Maybe the law gives a time of 6 months, right? That is not available in this fact. So we do not know by which date, if we don't do the cleanup, the default will arise, right?
Yes, right.
Yes or no?
Yes,
So unless and until the default has taken place, right? So the only provision is for the best estimate of the cost of the cleanup, correct?
yes, right. For clean up only, yes.
Yes, right? Any questions, anybody? Okay. One more example. An entity in the oil industry having 31st March year end causes contamination and operates in the country where there is no environmental law. Okay. However, the entity has widely published environmental policy in which it undertakes to do the cleanup of all the contamination that it has caused. The entity has a record of honoring this published policy in the past. It is assumed that a reliable estimate can be made. Now, past event. Past event is what? Contamination.
Yes, contamination is a past event.
So contamination is the past event which is already done. Now, law is not there for the cleanup. So there is no legal obligation, correct?
There would be constructive obligation.
But there is a constructive obligation because company has by its environment policy set the expectation to the public that it will take the cleanup activity, right? So there is a constructive obligating event by virtue of the past event, which is the contamination which has already occurred. So past event contamination has already occurred. Constructive obligation because of this environment policy the company has published on its website and advertised to the public at large has assumed a constructive obligation. So past event plus constructive obligation means probability of outflow is there. Yes or no? Since outflow
Yes,
is probable, and reliable estimate factors can be measured. So provision will be
Made.
recognized for the cleanup, correct? Any questions on the provisions before I proceed with the contingent liability discussion? So we are understanding the concepts, right? We will do the numericals as well. So once we are done with the understanding of the three concepts, provisions, contingent liability, and contingent asset, which are the three items which the standard deals with, then thereafter we will do certain numericals. So please keep the calculators ready in the next session, right? Okay, contingent liability. So provisions are recorded in the books of accounts. Yes or no?
Yes.
Yes. Contingent liabilities are not recorded. Is that clear?
Yes, clear.
So we are not going to do any accounting as such for the contingent liabilities, correct? But we will be making disclosures about all the contingent liabilities which we are able to identify basis this standard, right? So what do you mean by contingent liability? Possible obligation. Are you able to notice something? Under the provision, the word was
Present obligation.
present
Yes.
obligation,
Yes.
correct? But here, the obligation is possible. So, the obligation is not present, right? But there are chances that some obligation can arise. Arise from what? From a past
Past
event.
event.
So, past event has already occurred or not? Correct? Occurred. But this past event will be confirmed by some future event as well. So, event, sorry. Slide is back.
Yes, back.
Okay. So, event in this case is the past event as well as the future event. So, some event has occurred, which is as the past, right? It is occurred, already done. And it will be confirmed by some future event that whether this past event which has occurred will result into a obligation or not, right? And that future event is not wholly within the control of the entity. So entity cannot control, right? It depends, right? So we will do some examples to understand it but better. But let's focus on the keywords of the definition given by the standard, right? So obligation is not present, it is a possible. And event, although some event has occurred, but some event is awaited to be occurring in the future, right? So maybe I can say event is not fully occurred, right? Maybe event has partially occurred and some portion of event is still unoccurred. Or maybe one event has occurred, but it will takes place of a constructive obligation only if some additional future event occurs, which will conform to this, right? So there are some contingencies involved in terms of getting the event completed, right? So event is not yet complete in the contingent liability case, right? Or so this is the one section of the definition, and then there is a or, right? Then the second section of the definition is obligation is what? Present. So in this
Present
case,
obligation.
obligation is present arising from a past event. So event is a past event, obligation is a present, of which outflow is not probable. right? Outflow is not probable. Although event is there, obligation has arisen, that is a present obligation. But when I see whether I need to pay something, the answer is no. So if I am not expected to pay anything, then what liability I will record? Nothing, right? So let me correlate this with my previous example. Pharma company. Pharma company sold the drug. Customer bought the drug on doctor's prescription, right? Customer got some serious health issues and side effects. It, filed a sue against the company in the court of law, asking 1 crore damage, right? When the facts were investigated, it was found that the drug had a issue, right? Technical issue, ingredient issue, right? Whatever. Then the onus lies on the company, yes or no?
Yes.
Right? So in that case, past event was the consumption of the drug by the customer and getting the health issues, right? By virtue of that, customer filed a case and asked for 1 crore damage, and hence it resulted into a present obligation on the part of the company, right? Now, event is same, present obligation is there, but when we did the research, lawyer said, and team of doctors advised lawyers that drug is fine. It is approved by the WHO and the FDA, whatever, and there is no technical default or fault in the drug. It is a matter of fact that the customer was, having an issue with a particular ingredient of the drug, which the customer knows, and he failed to tell this to the doctor that I have a sensitivity with this particular item, right? And the doctors, in the absence of knowing this, prescribed this drug, and the customer consumed and got the serious health issues. Now, what do you think? Whether the company in this case is liable to pay anything to the customer?
No.
Generally not, because customer was known that he has a sensitivity to a particular ingredient, and that ingredient sensitivity customer knows in the past because he has faced such issues in the past as well with some certain other drugs having that ingredient, and it was established fact in the medical history of that customer, but customer didn't tell this to the doctor because was not aware, prescribed this medicine because this is one of the best medicine available in the market for a particular disease, and the customer got serious health issues. So when all this R&D was done and team of doctors said that this is a default of the customer only, neither the doctor nor the company, right? Then in this case, past event, same past event, yes. Present obligation because of past event, yes. But whether I am supposed to pay anything, in general, not, even if the court is not yet deciding the case. Court has not yet decided the case. So probable of economic benefits outflow is not probable in this case. Yes or no?
Yes. Not
Right?
probable.
Not probable. But because the court's decision is awaited, so there is a future event, that is the decision of the court, which is not in the control of the entity. Is that correct?
Yes, correct.
Correct. So unless and until that decision comes in, can we say, boss, we don't have any obligation because of this matter? No. Even if the company knows that they will win the case and there wouldn't be any outflow, right? But there is a future event on which the company is dependent. Suppose one fine day court comes and says, no, it is a company's fault, right? For any reason. Then whether the liability gets crystallized or not.
Yes, it gets crystallized in that case, yes.
Right? Although the company may go for in a higher court and challenge, that is a separate thing. But at least if the court decides against the company, even in this case, then the provision will be required to be recorded, yes or no, basis on the court decision outcome. Yes.
Yes.
But because the court decision has not yet arrived, so in the absence of the final clarity, can we say that we can simply avoid this? No. So in the books of accounts, although the provision is not required, but the contingent liability disclosure will be required. And why it is named as liability which is contingent? Because contingency is there. That is the court's final outcome. Liability, because it is a liability only. If the court rules against the company, it will be a liability. Yes or no? But because that ruling has not yet arrived, so it is contingent. That's why the name is contingent liability. Correct?
Yes.
So there are three things. First is the liability. Second is the provision. And third is the contingent liability. Correct? So liability, it is a clear-cut liability. I know to whom I need to pay. I know how much I need to pay. Correct? So it is recorded on the very same date as and when the transaction took place. Correct? Like purchase and sale of purchase or of goods and services from the vendor. Right? Then the next item comes provision. So provision is made where the outflow is probable, although the timing and amount may vary. So either I do not know the timing or I do not know the amount clearly, right? So that's why I say this is not a crystal liability or clear liability. This is a provisional liability. So instead of calling provisional liability, I simply say provision. So provisions are recorded. And then third item comes as contingent liability. So these are those liabilities which have not yet arose on the company, but may arise in future, provided certain future event occurs, right? If that future event occurs, court decision comes against the company, then this will be a liability payable by the company. Hence, until then, we will say it a contingent liability because it is not a provision, because lawyers are saying, boss, 99% you will win the case. So there is no expected outflow or probable outflow. Because there is no probable outflow, so provision is not required to be made. But contingent liability disclosure is still required by the standard. Is that clear?
Clear. Clear.
Now, why we are, you know, why the standard is looking for a disclosure for contingent liability? What is the objective?
To make the users of the financial statements understand.
Right. So to make the users of the financial statements understand that these are the set of items which company has not yet recognized as liability in the books of accounts because they have not yet turned into provision or the liability. But in future, they may turn, right? In case they turn, then what would be the amount which the company will need to discharge in future so that users will be able to understand what is the significance of these contingent liabilities, right? So sometimes in some of the construction companies or real estate companies, a balance sheets, if you refer by any chance, you will see a long list of contingent liabilities, right? And if those turn into actual liabilities, then it will be a balance sheet disaster. Correct? Assets will go away in settling those liabilities, right? Company may become bankrupt as well. So investors will lose the money. So that's why this disclosure is very important, so that investors get to know what all contingent events are there, which, if confirmed against the company, then how much amount the company will have to incur additionally, right? So that is a crucial disclosure which highlights the risk in the company. Correct?
Yes.
So what contingent liability in nutshell means? Contingent liability means possible obligation from the past event and or outflow is not probable or unable to measure the amount. So if the amount is not measurable, then certainly disclosure will also not be possible apart from the facts, right? So there could be possible amounts are not measurable. So in that case, what will happen? Simply the nature of the contingent liability will be disclosed, right? Stating the range in which the liability can arise if arises, rather than giving a fixed amount. So sometimes you see in some companies' balance sheet, in the contingent liability schedule, the range of amount is given 5 crore to 15 crore, right? Something like that is also given, so that range is disclosed, that if the liability gets crystallized by virtue of any possibility, then liability will stand somewhere in between these 2 points, right? Okay, let's do the example. A tax case pending before the court, the liability for payment arising or not in respect of which depends on the outcome of the court, is a possible obligation that arises from past event and whose existence will be confirmed only when the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity, right, occur. So in this case, what is happening? So there is a tax case pending in the court, right? And the matter under dispute will have certain additional tax payment obligation on the part of the company, right? Maybe the court is pending in the CIT appeals or the ITAT or the High Court or the Supreme Court, wherever, whichever is the platform or forum, right? The case is pending, right? Now, in these situations, what the company generally does. So if the company believes that certainly, there are chances of losing this case because there are certain similar cases decided in the past in case of other assessees, basis on which company will also get dragged into, these and, will be asked to make the payment. So in those cases, provision will be recorded, yes or no? Yes. In those cases, provisions will be recorded. But what if the company has a case, where under similar facts or situations, the case was decided against the department only, right? Or in favor of that assessee. Then in that case, company has the chances of winning the case, yes or no? Yes. So in
Yes.
that case, the obligation is not present. It is a possible obligation and will be confirmed by the decision of the court, which is a future event, which is not in the control of the entity. Hence, this will be disclosed as a contingent liability if the provision is not made because the provision criteria were not met. Correct? Yes
Yes,
or no?
correct. Yes.
Okay. So let's do this one. After a wedding in 2001 2002, 10 people died, possibly as a result of food poisoning from the product sold by the entity. Legal proceedings are started seeking damages from the entity, but it disputes the liability. So, suppose the company was a wedding planner and organizer. It was, into the business of arranging, decoration and foods and the banquets, right? So it has arranged the food for the public at large who have attended the wedding. But out of those people, 10 people have died, possibly because of the food poisoning, and they have filed a case against the company seeking damages. So that's the situation. Up to the date of the approval of the financial statements for this company, that is 31st March 2002, for the issue, the entity's lawyers advise that it is probable that the entity will not be found guilty or liable, right? However, when the entity prepares the financial statements for the year ended 31st March 2003, that is the next year, its lawyers advise that owing to the developments in the case, it is probable that the entity will found be liable. It is assumed that reliable estimate of the any outflows are can be made, right? What is your advice for both the financial statements, 2002 and 2003?
In 2, X2, it will be a contingent liability, and in X3, it
Mhm.
would be a provision would be made, required
Okay.
to be made in the
Why?
financial statement.
So let's follow the rule book. Okay. So whenever we do these questions, we promise to ourselves that we will not answer on our gut feeling, right? So sometimes we answer the on basis on the gut feeling, right? So we will simply follow the rule book. What is the past event? what is the past event?
Food poisoning people.
So past event is death of people, right?
Death of people because of food poisoning. Yes.
Because of consumption of food provided by the entity. ठीक है? Correct?
Yes.
So
Yes.
this event has already occurred, yes or no?
It has occurred. Yes.
So this is the past event. Now, by virtue of this past event, the companies, these people, legal heirs, have filed a case, right, in the court against the company, right? Filing this case is making a obligation on the part of the company, right, as a legal obligation, right?
Yes.
So there is a past event and there is a legal obligation, right? Now, this legal obligation is present depending on the facts whether the company expects any outflows probable. So, in the given basis, the facts given in the question in 2001, lawyers advise that there is no probability, right? Right? That the company will
His
be
outflow, yes, is not
liable for
probable.
any uh, outflows, right? So there was no present obligation by virtue of this past event. So past event was there, but there was no present obligation. So what obligation was that? Possible obligation? Yes or no?
Yes.
So since it was a past event plus possible obligation, so the answer comes to contingent liability. But in the second case, past event plus present obligation, the answer comes to provision. Estimate is always measured reliably, given in the question. Correct?
Yes. Correct.
So this is the answer. You can refer. Okay. So let's do this one. X Limited, X Chemical Limited is operating in the vicinity of a river since 20 years. A community living near X Chemical Limited claims that its operations has caused the contamination of the drinking water, which they used to fetch from the river. X Chemical Limited has received a notice from the government environmental agency that the official investigations will be made into the claims of the pollutions caused by the entity. If it is found that X Limited has caused the contamination, then the penalties and fines would be levied. X Chemical Limited believes that it has implemented all environmental safety measures to the extent that it is unlikely to cause the pollution. Management is not sure whether it has all the information about the entire past 20 years. Therefore, neither the management nor the external experts are able to assess X Chemical Limited's responsibility till the investigation gets completed. In such a situation, how should management of X Limited account for this liability if it is required? What is your advice as a chartered accountant?
Yes, there is a past event which is contamination of the drinking water.
Mm-hmm. Contamination of the river, right? That is a past event.
Yes. Present obligation will arise when agency investigation. So penalties and fines would be the obligation if found guilty.
Guilty.
Yes.
And that is dependent on the survey gets completed,
Yes.
right? Survey will take some time, right? Outcome of survey
Yes.
is not in the hands of the company.
Yes.
So the obligation is present or possible?
Possible.
Possible. Okay. So you are saying past event is the contamination of the river and obligation is not present obligation, it is a possible obligation. That's what your answer is. So you are saying it would be a contingent liability,
Contingent
right?
liability. Yes.
Others, I'm seeing only one person is actually participating in answering. try to participate. Okay. So Ayush is saying it is a contingent liability. See what the standard says. As per the standard, in the present case, the available evidence does not support a conclusion that there is a present obligation. However, there is a possible obligation which exists and will be confirmed upon the completion of the survey, that is the investigation launched by the government on the company. Therefore, management should disclose this as a contingent liability for potential penalties and fines that may be imposed on the company if the contamination on the part of the company is proved, right? So, basis on the facts, we are not able to say that there is a present obligation. So past event plus possible obligation. If the survey report comes against the company, then there would be a present obligation. But until then, it is not, right? So we have to wait for the survey to be completed, right? And hence, until then, we will continue to record it as a contingent liability in our balance sheet. And in the year in which the survey gets completed, basis on that, we will decide if the survey says that we are defaulting and we have to pay fines and penalties, then we will convert this contingent liability into the provision. If we are not going to, if we are going to challenge it further, if we are not going to challenge and accepting, then it is a not even the provision. It is a clear liability in that case. Is that clear?
Clear.
Okay. So what are the principles describing the provisions and contingent liabilities which we have understood, right? So let's try to have a snapshot of that for our clear understanding. Where as a result of the past event, so certainly past event is crucial in both the cases, be it provision or be it contingent liability. There may be an outflow of resources embedding future economic benefits in the settlement of a present obligation or a possible obligation whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events which are not wholly within the control of the entity, right? So either there is a clear present obligation or there is a possible obligation which will turn into present dependent on the future event, right? Which are not in the control of the entity, right? So this is what we have understood and discussed since morning. If there is a present obligation that probably requires an outflow of resources, in that case, we will record a provision. Plus, we will make the disclosures for that provision. Clear? So two actions, accounting plus disclosure. Is that clear?
Clear.
If there is not a present obligation and there is a possible obligation or a present obligation that may or probably not require out of resources, then in that case, provision will not be recognized. At least this is sure shot, right?
Yes,
But
right.
disclosures are required for these contingent liabilities. So accounting के case में nothing is required, but disclosure is required. Correct? Here both accounting as well as disclosure is required. And if there is a possible obligation or a present obligation where the outflow is remote, neither the accounting nor the disclosure. Now, what do you mean by the word remote? So, in the case of provision, we say more than 50% chances. Correct?
Correct.
In the case of contingent liability, we say chances are more than 5%, but less than 50%. Is that clear?
Yes, clear.
And in this case, chances are less than 5%. So in such a situation, we will say there is no action required, right? Neither accounting nor disclosure, because it is not even meeting the contingent liability definition. So contingent liability means where there are chances. Chances means more than 5% at least, right? But less than 50%. Because if it is more than 50%, then it will become probable, right? Correct? So it will take the shape of the provision. But if it is less than 50%, more than 5%, it is a contingent liability. And if it is less than 5%, nothing. Now, do we have these limits prescribed in the standard? Yes or no? No. So standard doesn't give any limits. This is just I told for our better understanding so that we are able to interpret the words used by the standard literature in terms of numerical value for easy understanding and remembering. So probable means more likely than not. More likely than not means more than 50%. So that's how we arrived at more than 50%. But the standard doesn't use more than 50%. The standard says probable. Probable means more likely than not. More likely than not means more than 50% mathematically. Correct?
Correct.
Not probable. Not probable means less than 50%. Right? But it is not saying remote. So it means more than at least 5%. And remote means rare. Right? So less than 5%. Clear?
Clear.
Any questions, doubts here? So in the examination, by any chance, if any such question comes in, will you be supporting your answer by giving these limits? More than 50%, less than 50%, more than 5%? No.
No,
What you will be doing? You
we
will
should.
only be using the words. The words are probable. Words are not probable. Words are remote. Is that clear? So in the case of provision, it is the probable. In the case of CL, contingent liability, it is not probable. And in the case of not even contingent liability, it is remote, right? So you will not use these limits. Correct?
Correct.
Perfect. So last item for the day, contingent asset, right? And this is the new item, which we have never studied under ICAI. Is that correct? Or have you studied contingent asset in
Not
ICAI?
study. No,
Not, not, right? So provision contingent liability still we were familiar with, right? We did some revision and we understood the concept with the examples which we did today. But at least we were familiar with those items. But this is altogether new item, right? So no IGAP was referring to contingent asset. So this is a new item under NTS, right? So new item. Now, what do you mean by contingent asset? So can we draw a reference from the word contingent liability? Yes. So the way the liabilities were contingent depending on certain future event not within the control of the entity. If they get crystallized, company will be paying something. If they don't get crystallized, company will not be paying something. And hence, because the clarity is not there on the day we are preparing the financial statement, so we call them as contingent liability. The mirror effect of this would be the contingent asset. For example, possible asset that arises from a past event to be confirmed by the future events not wholly within the control of the entity. Now think from the perspective of the two parties in the court of law. So for one, it would be a contingent liability. For the other, it could be a contingent asset. Yes or no?
Yes. Yes.
Because if one party loses, then the other party gains. Damages, right? So if one party, in the absence of the court decision, calls it out as a contingent liability in their books, the other party can report it as a contingent asset. Yes or no?
Yes.
So contingent asset usually arise from unplanned or other unexpected events that give rise to the possibility of an inflow of the economic benefits to the entity, right? So the something which the company did not plan, or something the company was not expecting, but suddenly by the mercy of the god or nature or by the luck, the company is getting some windfall gains, right? So those unexpected events which the company were not expecting to turn in their favor are actually getting turned into their favor and resulting into some inflow of economic benefits, right? So this is the contingent asset. The standard states that a contingent asset should not be recognized. So accounting is prohibited. So we are not going to record this contingent asset on our balance sheet, right? So balance sheet will not have these contingent asset. Although the name is asset, but because they are contingent, they are not yet arise to the company. Hence, it cannot be recorded. So standard is explicitly prohibiting to record these assets in the balance sheet, right? As this could give a rise to the recognition of income that may never be realized. However, when the realization of income is virtually certain, then the related asset is no longer regarded as a contingent and hence the recognition is appropriate. So, as and when the contingency gets resolved and certainty gets established that there will be a inflow to the company. For example, winning of a court case, right? So damages will be accruing to the company, right? Court has passed the decision in favor of the company that A Limited is supposed to pay you rupees 1 crore, right? So B Limited will be now, having the legal right to receive 1 crore from A Limited, yes or no? So now they should record the debtor, A Limited as debtor for 1 crore, yes. Is that correct?
Yes, correct.
So let's do this example. X Limited filed a legal suit against against a supplier of the goods for compensation against damages for non-supply of the contracted goods. This meets the definition of a contingent asset. Since there is a possible asset compensation against damages which will arise to the company from the past event, that is the contract which they have signed with the supplier, and the existence will be confirmed by the occurrence or non-occurrence of the uncertain future event not wholly within the control of the company, that is the outcome of the legal suit. So if the court decides in favor of the company that supplier needs to pay the penalty to the buyer, then the buyer company will eventually be receiving the damages. So those damages will be treated as income for the buyer, yes or no, after the court decision? Yes. So
Yes.
the buyer company will accrue those income in the P&L and record the corresponding asset. So what the item would be in that case? So asset account debit, that is debtor, correct? Debtor account debit to P&L, right? Whatever the amount is after the court decision. But until the court decision in the favor, this entry cannot be passed. And in the disclosure, it can continue to be disclosed as contingent asset. Yes or no?
Yes.
Right? So this is the new item in our balance sheet, which we have never seen in the ICAI financial statements. So in ICAI financial statements, we were only seeing the disclosures of the contingent liabilities, but in the India's financials, we will also see the disclosure of contingent assets. Would you like to try this question before we conclude the session today? X Sugars Limited has entered into a sale contract of rupees. How much is this?
3 crores.
3 crores with Y Chocolates Limited for the supply of sugar during 2012. As per the contract, the delivery is to be made within the 2 months from the date of the contract. In the case of the failure to deliver within the schedule agreed schedule, X Limited has to pay the compensation of rupees 30 lakhs to Y Chocolates, right? So Y Chocolates has entered into a contract to buy the sugars from the sugar company. And if the sugar company defaults on making a delivery of the sugar within the stipulated delivery schedule, then they will be liable to pay 30 lakhs to the Y Chocolates as per the terms of the contract. During the transit, the vehicle carrying the sugar met the accident and X Sugar Limited lost the entire consignment. Okay, the truck, fell into the river and the consignment is lost during the transit. It is, however, covered under an insurance policy. According to the report of the surveyor, the amount is collectible and subject to deductible clause, that is 15% of the claim in the insurance policy. The cost of the goods sold lost was how much? 2 crore 50 lakhs. Before the financial year ends, X Sugar Limited received informal information from the insurance company that their claim had been processed and the payment had been dispatched for 85% of the claim amount. Meanwhile, Y Chocolates Limited has made a demand of rupees 30 lakh since the goods were not delivered on time. As a chartered accountant, you were hired to advise the management for all the necessary disclosures to be made in the financial statements for the year end. What is your advice? And these are the examination questions. Past examination. Anji. What are the disclosures in the books of X Limited, Sugar Company?
There is a past event.
What is the past event? What is the past event?
Contract to supply the chocolates. And
Contract to supply the chocolates within a delivery stipulated delivery schedule.
2 months, yes.
2 months, right? This is the past event.
And if the delivery is not made within 2 months, then the company have to pay 30 lakh rupees as compensation.
So past event is what? Past event is not able to meet the delivery schedule, right? That is the past event. Correct?
Correct, yes.
So reason could be any, right? Whether the company was not able to manufacture or whether the company was not able to dispatch, whether the company's truck was lost in the transit. So reason could be any. The past event is delivery was not made as agreed. Right?
Yes. And there is
So
a
this is the
present
past event.
obligation.
Now, because of this past event, is there any present obligation?
Yes, there is present obligation to pay compensation of 30 lakh rupees.
30 lakh rupees. This 30 lakh rupees present obligation is constructive obligation or the legal obligation?
This is the legal obligation, I think, because it is given in the contract.
Right. So it is a contractually driven. So it is a legal obligation because if the company doesn't comply, then the other party, the chocolates company, can sue the sugar company in the court of law. Yes or no?
Yes, yes.
So this is a legal obligating event arising out of a failure to deliver on time as a past event, right? So
Yes.
it is a present obligation. So 30 lakh is the present obligation. Is that clear?
Yes.
First condition, past event has occurred. Yes, past event has occurred. Second, present obligation because of past event has arisen. Yes, it has arisen. Third, outflow of economic resources is probable. 30 lakh is
It is
payable.
probable, yes.
Yes,
Yes.
probable. Right. Fourth, estimate can be
Estimate
measured
can be made.
reliably. Estimate is already given in the question, 30 lakh.
Yes,
Right.
provision should be made.
So all the four conditions are met. So 30 lakh provision needs to be recorded, yes or no?
Yes, provision should be made.
Provision should be recorded.
Or 30 lakhs, yes.
30 lakh. What else we need to do? What all this insurance jamela? There is something.
Contingent asset.
So what is the contingent asset?
The receipt of the insurance claim from the insurance company, that would be 85% of the 2 crore 50 lakhs.
So Ayush is saying past event is not supplying on time. Since the demand is not disputed, X Limited will recognize a liability of rupees 30 lakh. Provision of 30 lakh. Okay. I guess we need to record a liability since since there is no uncertainty as to the time or amount. Okay. So you are saying it is not a provision, it is a liability, Ayush, right? Okay. Okay. What about contingent asset, Ayush? Any contingent asset also needs to be disclosed? Or we should completely ignore this all insurance paragraph altogether? Or is there any actionable on that as well? Okay. You are saying contingent liability also needs to be disclosed. And you, Sanjay is also saying the same thing, right? So let's see. As per the standard where the inflow of economic benefit is probable, an entity should disclose a brief description of the nature of the contingent asset at the end of the reporting period, and where practicable, an estimate of their financial effect measured using the principle set out in Ind AS 37, right? So X Sugars Limited would need to disclose a contingent asset of rupees 2 crore 12 lakh 50,000. That is 2 crore 50 lakh into my 85% given in the question. That 85% claim is passed by the insurance company, not the 100%, right? So we will calculate the amount at the end of the 2012, right? So this contingent asset will be disclosed. Furthermore, it will make a provision of rupees 30 lakh towards the claim of the white chocolates, right? As per the provision. So two disclosures, one the provision, another the contingent asset. Now to Ayush point that it will be a liability, not the provision. No, it will be a provision only, because it can still be disputed by the sugar company saying that we have transitioned, but because of something which was not in our control, the truck fell into the river from the bridge and the sugar got spoiled, hence we are not liable to pay 30 lakhs. So Ayush, if you are stepping into the shoes of that businessman of the sugar company, will you not contest this 30 lakh claim, or you will hand over the check on the day one itself? Oh, the consignment didn't reach you, please accept 30 lakh. What are your thoughts? Will you contest or not? Yes, we will contest. So as a businessman, you are prudent enough to contest, but as an advisor to the businessman, you are saying it is a liability. Why discrimination? So if you are in the business but not given in the question, what is not given in the question? No, 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 boss. No, no, no. So contesting is not given in the question, I agree. But this matter is not a clear liability, because every prudent person will say that the truck has left from our godown, and because of something out of our control, didn't reach to you. Hence, you shouldn't be demanding this 30 lakh penalty, right? So this is a normal thing, right? Hence, it is not a liability unless and until accepted by the sugar company, X Limited. So if X Limited confirms that, okay, we are okay to pay 30 lakh, then you can say, right? So it is a provision only, because the question fact says the demand letter from the chocolates company has received, right? But on that demand letter, whatever the action the company has taken is not given in the question. Are you agreeing with me? No, 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 no. Don't get confused that acceptance is needed. I'm not saying that. The only thing I'm saying that at this stage is we have received a demand letter and we are just reading the demand letter. Okay, 30 lakh is being asked. So immediate action, provision is there. Whether we are going to contest or negotiate, that is a secondary. But provision is there because timing and amount is not confirmed, right? I can challenge that I'm not going to pay, or I can challenge, okay, because your business is also affected, but you see my situation. I have dispatched the goods, but the goods didn't reach to you because of some accident which was not in my control. Hence, let's negotiate. Instead of 30 lakhs, are you happy to take 10 lakhs or 15 lakhs, right? So that negotiation can happen, right? If the negotiation doesn't conclude, then certainly there would be a case, right, by the chocolates on the sugar. So those are secondary things unfolding in the future. But on this date, when I received the demand letter, I cannot say it is my liability, right? But still, it is a provision. Is that clear? Right? Perfect. So I think it's 10 o'clock, 10:05. Let's wind up the session for today. And we have discussed all the three concepts supported by various, practical questions. I hope the concepts were clear to you. In the next session, we will talk about the measurement rules, how the provisions are measured, right? How they will be accounted for, right? What are the measurement rules, and what all disclosures around the provisions, contingent liabilities, and contingent assets needs to be disclosed, and we will do some numericals. So I conclude the session now, and I wish you all the very best this festive season. Thank you for listening me patiently. Have a good day.
Thank you. Thank you very much. Happy Diwali.
Thank you. Same to you. Bye. Yes, session is over.